Hey everyone, welcome back to the funding table. So we're going to look at the funding table, and it's an important concept for you to understand, and also make sure that you can use that in this feasibility. So basically, in a nutshell, what happens is that you might have incurred a lot of costs. So say, for example, you incurred costs on land finance over here, and your land loan refinance. You incurred all these costs over here. However, those costs technically are part of the cost for the development, because that is the reason you got that land. That is the reason you did that. However, when it comes to funding for construction, because this funding table is part of the construction finance. But before we can get to the construction finance, we need to understand what a funding table is. So in here, what is happening is that we are trying to figure out the hard costs and all the soft costs that you have incurred throughout your development project. Because the bank may or may not consider certain soft costs as part of the total development cost, because whatever they come up with as their total for all the development costs, that is what they're going to use as a total cost for the project. And against that total cost, they will give you an LVR of 65% or 70% or 75%, whatever. It depends upon the lender. But they will lend you based on the total development cost that they think is the total development cost. And it may or may not include certain soft costs that are in the project. So this funding table, what it actually does is that it gives you a full flexibility of figuring out all the costs for the development that have been incurred. Now this is for all the detailed costs for all the settlement of the project. So remember, if you were to go and update certain cost codes over here, you will need to come and update those cost codes over here as well. Now this is black at the moment, but they can be changed. You can change them if you wanted to. So just saying that they are all linked together. So we've got stamp duty, all these things. So what they want to see, when you settle on a block of land, the bank will always lend you money based on the total valuation of the block, which was 1.2 million. That is if they considered that 1.2 million was the correct valuation of the site. If not, they'll do something else, and I'll explain you in the next video. But over here we have this option, but they will not consider 66,000 that you paid for the stamp duty or the property tax or whatever. And when they lend you the money, that means that they are only considering that cost instead of 66. So you are out of pocket 66. That means, what is your developer's share? That means you're funding 100% of that total cost. So this is what that percentage does. So if you are able to negotiate a deal with the vendor and you say, look, I'm not paying I'm not even paying the stamp duty for it, you can put that as 0, and that cost will get allocated towards the lender TDC. Otherwise, you can select 50% or whatever percentage of that amount you think that you will have to pick up that extra bit. You have to put in 100%. So that means you're picking up all those extra costs that you have incurred or may incur in a project, so that the bank will then consider based on what are the hard costs. That means there could be costs, for example, site works that the developer has to do, like cut and fill. Even before I hand it over to a builder, I would clean out the site myself. Like I'll arrange the demolition, I'll arrange the site cut and fill, and make sure everything is ready to go for the builder. So those are certain hard costs, but they are not part of the build contract. So those are the costs that bank may consider as part of the total development cost. But your interest calculation, if for holding that land. So over here, all these interest calculations, that the interest that is owed, although part of the project, it will not be considered as as banks TDC. So this funding table gives you full flexibility where you can come in and say, hey, I've got other land acquisition costs, and developers funding 100% of them. I've got stat fees and contributions. In some scenarios, bank may consider that, and in some scenarios, they may not consider that. So you've got, let's say we've got 103,000 of that, and we are putting in and saying that, look, 50% bank is going to say yes, and 50% you as a developer will have to foot the bill. So those are the things. So like there are certain holding costs, like you are paying your bookkeeper and all these things. Bank may not consider that as the total development cost for the project. So you will need to come in and put in your details over here. So for example, drawings and consultant, it could be 50%, which is related to construction drawings or working drawings for the building permit. Banks sometimes will consider that amount as part of the total cost, and sometimes they don't, depending upon what you negotiate with them. Because this is totally fluid and I have never seen this anywhere else, I decided to build this and put it in the feasibility, so it gives you full flexibility to decide which costs are you going to pick up and which costs the bank will consider as part of their TDC. Now, it doesn't mean that they are going to foot this full total amount over here. It just means that this is your total development cost could be this. That includes even a stamp that you bought to post a letter to somebody. That is actually the cost of the development. However, bank's gonna say no, we will only consider 10 million as the total development cost based on the valuation that came in for the land, based on all the hard costs that they want to include in that. And based on that 10 million in our funding options, we can then select which option is the bank picking up as your total development cost, or your gross GRV, which is the gross realization value. So based on these things, these are the options that you will have, and we'll go into that. But what you need to understand is what are the soft costs that you will be asked to pick up. So if you are going to pick up all the entire 12,000, which is finance ancillary costs, could be accountant's bill, could be some consultation with some financial advisor or whatever that you might have paid for. Bank may not consider that as your total development cost. So you need to be very clear of what they will and what they won't in order to come up with a bank's TDC. So I call it the lender's TDC or the bank's TDC, this is what the bank is going to consider as the total cost. So they will consider the total cost of construction. So over here we have 0. So site works as a developer is a hard cost, and they will consider that as a total development cost. And then we've got certain service connection fees, which may not be part of the contract, but those are the services that will be connected to the site: gas, water, electricity, and you might be paying that, but you can negotiate these costs with your lender so that they are included as part of the total development cost. See, your idea when you're trying to secure a loan with a lender for construction is to inflate the lender's TDC as much as possible, which basically means that you can borrow as much as possible, and which basically equates to you putting the least amount of cash as possible from your own pocket. So that is what this lender's TDC is all about. So if you are in here, you've got this number over there, and then this section we've got all these options over here. We've got lender's calculated TDC. That means what we've done in the funding table. Then we've got the total project development cost, which is your total development costs when you sell the project. They will not include any GST, because if there is a GST, it will be taken out from there. Project's gross realization value excluding other income, and other basically means that you know that bank's considering. So this is a manual override kind of thing where it doesn't override, but it gives you an option to put in an amount manually and then select it for construction finance. But I'll show you how that works. So you might say that, look, bank is only going to consider $8 million total development cost, and you send everything to them. They've looked at everything and they come back and say, look, it's going to be just 8 million. So you can put in a manual 8 million in there and then put in key in a loan to value ratio for that. So that means you are borrowing against that total amount. That is what all this is all about. So you've got your this section was total project development cost, which was this section over here, and then project gross realization value excluding other income, which basically means that, you know, if you rent the property during that time, they will not consider that as your gross realization value. So that is not included in there. So and you got other, which is $8 million or whatever, and then you can put an LVR over here. Based on this, they will calculate. You will know that this is the developer's equity you would require if you went with this option. If you went with the total development cost, the bank says, okay, whatever you spend, let us know, we'll lend you money on the total development cost. That is including the stamp. They'll even pay you $1 for the stamp that you stuck on a letter and you posted to your lawyer or whoever. So if you've got a receipt for it, you give it to them, and that's this option, which is seldom the case. And the third option is a lot of second-tier lenders or hard money lenders or shark lenders. They can sometimes lend you based on the total value of the project. That is, you've got 10 units, you sell each unit $1 million. So they might lend you money based on $10 million, but you will always have a lower loan to value ratio and a higher interest rate. So you can change these things in there and select them. So you've got other, which is a manual section, and then you are done. So what we're going to do is we're going to press save and refresh. You don't really need to. Again, as I said, because I want to show you the impact for each section. So let's just go save and refresh, and this will then do a calculation, and we'll be able to get a number here based on our based on the percentage that we put in of the developer's share of the total development cost, which is the money that's coming out of your pocket. So based on that, the biggest thing to look at is that you will need this amount of money in order to fund this project, and this is what will come as debt. So if you've got this section here, this will, you know, say 6.5 million will come as debt, and you'll need to put in 5.6. Now, you know, although the bank is saying we'll give you 65%, but did you notice the effective LVR or LTV, which is the loan to value ratio, after they've done all these calculations, is not 65, it's actually 53. So these are the things that a lot of developers get caught out with and cannot understand the total amount of money that they should have in order to do the development. So this is super duper important for you to understand. And I'll see you in the next video.